Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMBU in Manhattan. I'm also the head trader of SMB's Options Trading Desk. So this week I'd like to talk about what happens to traders who get greedy, they get bored, they get too excited about a strategy, that they have had limited success in, and they suddenly start to feel they're invincible. So I've called this video, Don't Push Your Luck. And it arose out of a mentoring session I was having this week with a student who did something very similar to what I'm about to show you on this video to give you a feel for why it is a very good idea to stick to your plan. So I've spoken in the past about what was called irrational exuberance by Fed Chairman Alan Greenspan when he was Fed Chairman a couple chairmans back. And that was basically the principle that you get overly excited about recent successes. You get overly excited about something positive that's been happening on a somewhat consistent basis, and you start to generalize and think it's going to happen forever in a positive way. And that will translate for an options trader oftentimes into you have a small, short winning streak on some strategy. And you start to think, hey, this is easy. And you have that tendency to think it's easy. And whenever you start thinking trading is easy, you really got to stop and remind yourself that it's not, that you've had success and you've had failure. In any event, it's not easy. If it was that easy, everyone would quit their job and trade. If you're a successful trader, you know you've been through difficult times, you've been through great times, and ultimately you start to get your sea legs and get consistent, but you're always going to continue to experience positive periods and negative periods. So let's say, as an example, you develop a simple credit spread strategy. Real simple. It says if the market is, if a particular stock is above its 20-day moving average for a couple of days, you can put on a bullish credit spread, one standard deviation out of the money, and then you establish a target profit. If you hit your target profit, then you close the trade, and you wait for the next time that stock moves upwards, crossing its 20-day moving average. So here's an example of Google on May 26th, and it had been above its 20-day moving average for a couple days. So if you had back tested it and this strategy had a positive expectancy over a long period of time, then you'd go ahead and slap on your put credit spread, which in this case would have been at 690. That's about one standard deviation out. So the short strike of the put credit spread was 690. And lo and behold, 6 days later, you hit your profit target, which in this hypothetical example is $1,000, and you're out of the trade. Here comes the dangerous part. You get bored, and you say, hey, that was easy, and I'm bored. There's nothing good on TV today, no Gilligan's Island reruns or Seinfeld reruns or whatever. So I think I'll just slap on another bullish credit spread. After all, Google's above its 20-day moving average. It was easy last time, it ought to be easy this time. And what just happened with that thought process? What just happened with that thought process is you went from being a disciplined trader to being an undisciplined trader. Your back test says you do it once, and then you wait for the next cross, next time Google moves above its 20-day moving average, and you slap that bullish put credit spread on. It didn't say, hey, I'm bored, let's do it again. And there was a reason it didn't say that, and the reason may well have been that these 20-day moving average crosses will be somewhat helpful for a certain period of time, but you can't expect that effect to last forever. There are other implications, such as time has passed, and with the market continuing to rally on a particular stock, volatility is going to be coming out of that stock. You're going to get paid less for the credit spread. A lot of reasons why re-entering such a strategy to double dip, might not be such a great idea, and certainly is a bad idea if your plan is to trade your plan and not to improvise. And so let's take a look at what would have happened if you had re-entered the next day. And then all you had to do was wait 15 days later, and you lost a lot of money. And the reason you lost a lot of money is because you didn't follow your plan. Now, could Google have continued to rally? Of course it could have. But your plan was to make your $1,000 and leave and wait for the next cross. And that's how you become a consistently profitable trader, by coming up with a solid strategy that you tested that works long term and then following it. And so what's the moral of this story? If you backtest a strategy that works fine, then trade the strategy. Don't trade based on boredom. Boredom is not a valid reason to trade. The only reason to trade is to make money by entering into sound, disciplined strategies. If you want a hobby, go out and take up some hobby. Trading is not a hobby, and if you consider it to be a hobby, it'll be the most expensive, unsatisfying hobby you've ever had. It will be expensive, and you will be frustrated, and you will quit. And so it's not a hobby. You have to treat it like a business. If you start moving into the hobby mindset, you're really going to regret it. One of the great traders of all time, Ed Seykota, said the easiest thing in the world is to come up with a valid trading strategy, and the hardest thing in the world is to actually follow that strategy. And today is a very mild example of that. This is based on boredom. There's a lot of other reasons that people don't follow their strategies, but believe it or not, boredom is one of them. And it is absolutely something to be avoided as a reason to enter a trade. You've heard it once, you've heard it a million times. Plan your trade and then trade your plan. If you do that and you have a solid plan and there hasn't been some fundamental change in the marketplace which negates the validity of the plan, then you're going to most likely be a consistent trader long term. So plan your trade and then trade your plan, and you have a very, very good shot at being a consistently profitable options trader long term. Thanks very much, and we'll see you next week.